Good morning, students.
Good morning, sir.
Yeah. How are all of you doing?
Good morning, sir.
Hi. So, interestingly, what Mahesh said last week has come true. So this week, the market actually bounced around from the lows of around 15,200. The market bounced quite nicely, yes, around 600 points. So what do you think is going to happen soon? We'll take a look, but I want your opinion. Very, very important that you guys have an opinion on which way the stock market goes. It doesn't have to be right, but you need an opinion nonetheless. Students, what do you think?
See, for a week or two, it might go up, but again, it is expected to go down further.
Yeah, I agree. Yeah, I think so. I think the Monday at the open, it may be up, but I think we are going to hit those levels. The previous support on the Nifty has now become resistance likely because we broke well below that 15,600 level and made a new low near 15,200. My guess is that 15,850, that area is going to act as resistance. So, there is a global rally happening. So that's one probably the reason why Nifty went up. My guess is Monday's open will probably put in a good high. And after that, I think July, we will get a very, very big crash. I think probably my guess is we will probably make new lows below 1,500. So if you look, going back, let's wait for this chart to come. Net is again slow for some reason. There we go. So this is a Nifty. So it's interesting price action. If you look, this will tell you. So you can see how these Bollinger Bands are widening like this. Yeah, so, and it is still below the red line. So you can potentially see a move up to that red line possible. Though I think the chances of us going to 15,000 are more higher than this. If you look, that there was this big red candle that had it, and the high of that candle will probably be around 15,860, which is where on Monday the market will try to open, and my guess is that will act as resistance. That could possibly be the high of the week. I think more bad news is coming in July in terms of rate hikes and all that. The other notable thing, anybody watched? Students, any notable price action in any asset classes this week? One is this.
Right, $2 fall, right? Yeah.
Yeah, so this is what happened to crude oil.
Yeah.
Crude oil really has given a big crash. This is where you have to be really careful, guys, because the market is now transforming itself from an inflationary scenario to a deflationary scenario, and most big price collapses happen during deflation. So basically, demand is collapsing globally, but more than crude, the real action is here. Copper collapsed like anything this week, and despite all the rebound and all that, if you look, this is collapse. This is how a collapse looks like, right? So basically, copper is saying the economy is going to tank. Okay, so global recessionary fears are alive and well, and I think this is not fully factored in the stock market yet. So ultimately, what happens? You have inflation, prices go up, central banks raise interest rate to control that, then you have a deflationary collapse. And then central banks will have to actually cut rates like anything, like what Japan has been trying for 30 years, cutting interest rates to negative, and nothing can be done. Okay, so inflation can be controlled, but deflation very difficult to be coming out of deflation. Everything collapses, real estate collapses, stocks collapse. The only thing that will last is the dollar. And I think money will move into dollar-based assets very fast. So that's something. That's why if you see, normally on a week that is up, the rupee should be strong, right? But here you are, the rupee is very weak. And will likely become bigger. So you have to ask yourself this question, right? India is a net importer of oil, right? In fact, our biggest import is oil, right?
Yeah.
Yeah. So that has a direct bearing on the current account deficit, which is exports minus imports. Because of oil, our current account is always in a deficit. Okay. Our imports are always more than our exports, or including all software exports, etc. Blah, blah, blah. So the oil is our problem. So when oil collapses, you would expect the rupee to strengthen. Yes. Yes. And it will be beneficial. But look at this, the rupee is weakening. So why is that? Oil and the rupee should move in the opposite directions, right? When oil prices go up, rupee can be weak and vice versa, but this week oil prices collapsed and the rupee still is weak. Now, why is that? Any ideas, students? So this is again my thesis on deflation, right? So we always worry about inflation, right? So oil is saying basically there's no inflation, deflation is there. So why is the rupee collapsing? If deflation happens, money will go out of India back to the US. As a result, the dollar will be strong. So logic is very simple there. Yes. So normally when crude collapses, if it's in a regular market environment, the markets would zoom. In fact, the Nifty would have gone up 1,000 points if crude had collapsed like this. But it's not happening because we are worried about deflation and money leaving emerging economies like India and collapsing everything. So deflation is going to be something you'll be hearing for quite some time to come. I think the next 5 years. I think if we get a depression-like scenario, all bets are off. Nifty will lose a digit. Probably will break 7,500 pre-COVID crash lows, I think. So that is not immediate. I think that will be probably 6 months down the line.
Sir, I have a question here.
Yes, please go ahead. Yeah.
Yeah. So with this concern for US consumer inflation rates, right? US inflation rates are going high, right?
Yeah.
So for that, if the rates go high, definitely our currency will devalue, right? It's going down, correct? So when the currency goes down, definitely the cost of goods that would or the price of goods that would increase, right? Whatever we import to India,
Yes.
correct? Right. So in that scenario, shouldn't the price of the fuels or commodities that should go up, maybe not down?
So what happens is prices of commodities have gone up already and are causing this. Because they've gone up too much, demand is collapsing. People no longer can afford to buy them at these high prices. And given central banks are raising rates, the dollar is appreciating and pushing these commodity prices lower. So ultimately what will happen is high inflation often will lead to deflation.
Okay. Okay.
In when the economies are not growing as much, right? You could argue that India is still not caught up with the COVID loss in GDP, right? So this is the problem. When the economy is not growing that much, when you have high inflation, it will suddenly, central banks will raise interest rates trying to control it. But all it will do is weaken the economy and collapse everything. Yes, they will control inflation, no doubt. But it will be so highly, the policy making would be so highly targeting inflation that they would have no clue about how the yield curve is inverting, and ultimately you will have a recession. So right now, if you look at the bond market, the Indian yields are looking to invert 2-year versus 10-year. Sorry, 5-year versus 10-year, and I think the two other interest rates are looking to invert 1-year, 2-year also. So I think the yield curve, you would have studied the yield curve, right, in fixed income securities?
Yes, sir. Yeah.
Yes, sir.
Yeah, so that can predict recession. So if the yield curve inverts, I mean, short-term interest rates go above long-term interest rates, that is suggesting a recession is coming. And in recession, we don't worry about inflation. We always worry about deflation. More often than not, deflation is what is causing big recessionary collapse.
So the crude prices which we just saw in the chart, right? If we see over a period of maybe a week or a month, right? It's actually showing a little bit of bullish trend,
Yes.
not a bearish trend, right?
Yes,
So,
yes. So the interesting thing is, right? So this is the graph you're talking, right? So, so if you look, the long-term trend is still very much up. But the very long-term trend, if you look for 10, 15 years, crude, even after it went to 115, in 2008, the peak was 125. So we just tested that level. And every other commodity is crashing, right? If you look at crude, copper, metals, they all are crashing. So crude is the only thing that is left that is not crashed, right? So that is the scary part. So ultimately, crude, it is catching up. Economic weakness ultimately will catch up to everybody. So oil is basically a sign of economy, right? If all the factories are running at full speed, then oil's demand is going to be high. Remember, at one point, oil was trading at negative levels in the COVID era when demand absolutely collapsed. So looking at this monthly graph, do you mean to say that there has been so much demand in the world that oil went from near zero level to where it is today? I doubt that, right? So oil can come all the way down to 75 here in no time if demand dynamics don't improve. The one thing that pushed oil up was the Ukraine-Russia war, right?
Yeah.
So, but that was a knee-jerk reaction. But now the world economies look like heading into recession. And no matter how much oil is, that you probably don't need that Russian oil anymore to support the market. Yes, so ultimately, when things go up like this, they have a way of coming down to trend. Yes, and this is the same thing with anything you look at. So if you look at the Nifty, for example, this is the long-term graph. Yes, I agree with one thing you said. You should always look at long-term, not short-term, and plan the trend accordingly. So you can see how This is the graph you need to watch, guys. So this is the monthly graph of the Nifty. And after going straight up, you can see on the chart, it has decisively broken that red line. Yes, in the middle. So you can come all the way to the bottom here over the rest of the year near 1300 or so. Yes, you can see how the only time the red line has not broken forever, right? Only time it broke was during the COVID area, right? When COVID happened, you can see how it broke and it went even below the blue line at 7500. Yes, do you see that?
Yeah.
You see it, students? Yes, no?
Yes, sir. Yeah.
Yes, sir.
Yeah, so the point is this. So now we have again broken the red line. So my guess is it is going to probably by year end go to that blue line. Very law of averages, nothing else. Yes. So COVID was a case of economic collapse. Now again, another recession, which is going to be brought by high interest rate targeting by the global central banks, can easily push it here. And this is the biggest risk here for the Indian market. And I think very soon you may see something like this happen on some economic bad news or whatever. By the way, I think I made this comment in the last class. So when PPI or the WPI, wholesale price index led inflation, goes higher than the CPI, like what we have. This is a very rare time in Indian economics when the PPI, WPI, wholesale price index is greater than the CPI. What does that tell you? So that tells you that ultimately producers are not going to be able to pass on that price increases to consumers, right? So if that is the case, what will happen? They'll not be able to sell more. They'll have to sell a lot more to make money, and margins will get compressed and profitability will be coming down. So I think in the upcoming quarter, your earnings is not going to be very good. And I think the stock market usually tends to worry about that, right? And it will start falling down. The upcoming quarter's earnings release, Infosys will probably report July 13 or so, is my guess. And I think the IT companies started off. So I think that quarterly earnings numbers are not going to be good. And I think the market has very little time now to factor that. It will try and factor poor earnings numbers very soon, I think.
Yeah, I think already Accenture has already come up with their reports.
Yeah. Many have already started. And I think it will get progressively worse.
Right.
Yeah.
Yeah.
Any other interesting observations, students? So another thing, after this bigger rally, you would think risky assets like Bitcoin would go up. Yes, Bitcoin went up, but not by much. You can see how this is working out. You can see how Bitcoin has actually come down. I didn't realize this, but you can see how Bitcoin actually has touched the lower Bollinger line. Do you see that? So,
Yes.
so if Bitcoin has done that, then everybody else will eventually follow, right? Bitcoin is the most risky asset class out there. So I quite didn't see this. It's very interesting. I think you're going to see the other guys also come down here very fast. So imagine that, if that would happen. Gold has come to the middle line already. Yes. And so you can see this is a common occurrence. Most asset classes are right there. This is a moment. By the way, guys, what does this pattern look like to you? Does it look like a snake to you with its head?
Somewhat. Somewhat.
So, you know, there's a snake in the South American, a large snake called the anaconda.
Yeah. Yes, sir.
This is actually the anaconda pattern. Really, this is the anaconda pattern. So typically when this happens, the asset class in question, which is gold, usually collapses. It's going to swallow it up this. Yeah. So crazy. I thought gold was safe, maybe not. Interesting. I'm just seeing it for the first time. It's great. Yeah. So what about Indian stocks? So here's the IT guys.
TCS and Infosys, they've gone up mostly.
These guys are leading. Okay. So after a long time, almost peaking near 2000 level, you're seeing weakness here. Infosys is not able to close the weakness here. Can you see it? Yeah. The middle line, it is broken. It recently came up, tested it. Now it is getting ready to come down again, and it can come down to 1100 very fast if it goes to the lower Bollinger Band. It may take a few months, but yes, this is another problem. With oil prices collapsing, I think Reliance is in big trouble, I think. You can see it has not even come to the middle band. So 2300, it came initially, bounced off that. But I'm of the view that it's going to break it and come to 1700, that area. So these are some interesting things. This is where all trouble already started. In fact, it started right when these guys announced the merger with HDFC Bank. Have a look. Already at the lower Bollinger Band and struggling, yes, to make headway despite the big rally there, not doing much here, right? So this is dangerous, right? So HDFC, if this continues and it keeps heading lower, we could see it go to 1500 or so. And imagine what that will do to the Nifty. So that will probably take the Nifty to 13,000, etc. Of all these. The one good sector that has been surviving and doing rather well, which I was surprised this week, was the auto ones. So the auto ones are holding, but again, not very convincingly. So unless Maruti goes to 8,500, it can easily come back all the way to 7,500 and 6,300. Yes. But this week was good for the autos, right? Good week for the autos. Auto sector is holding up the whole market, in fact. But the collapsing guys are these. I wish I had ridden one of these things. I was looking at buying puts on Tata Steel, and then somehow at 1200, I had almost hit the trigger, and look what. This is dangerous. Tata Steel is headed to 500, guys. Terrible, but look at this graph here. Look at the collapse. From 1500, already 40% collapse, and not looking to stabilize anytime soon. Yes. Other smaller banks which have asset quality issues in the past. This is a bank that I'm looking at, and this has just touched that lower Bollinger, briefly violated it. This is in trouble. I think you are looking at a very dangerous situation happening here with IndusInd Bank. And my guess is it goes to 500. Yes. So already touching the lower Bollinger Band, big move coming. Yes. Likely down. Yes. And the reason I worry about this is already a bank like this has collapsed. Look at that. RBL Bank from 800, 700 has collapsed to what? 80% collapse. And we all know, yes, bank, what happened there? Another bank that went from 800 to 15 or whatever. So yeah, it's not even showing in the graph. Yeah. Hold, wrong bank. Look at the collapse there. At one point, we were 450, and now we have collapsed to 12. So these things happen in recession, depression, all those things. Yeah. So these are things to keep in mind, that craziness can happen when things go south. And copper also. This week was a very big dangerous sign that copper may go to 345 and even lower. Yeah, students. Okay, students, I uploaded an Excel sheet that shows all our calculations we did in the last class. You guys saw that?
Yes, sir. Yeah.
Yes, sir.
Are you ready with your presentations on your trade ideas?
Yes, sir. Yeah.
Okay, what about others? Mahesh,
Yes, sir.
you are ready? You'll do your presentation. I'll give you from let's say 12 o'clock onwards for that time. Yes, is that fine?
Okay, sir.
You need more time than that? Do you guys need more time than that?
No, so presentation in terms, actually, I mean, we've done it on the IQ trade options, and we
Yeah.
have the reasoning behind that. That's fine, right?
Yeah, that's what I want. So just walk me through the logic of why you bought or sold whatever you bought or sold.
Okay.
Okay. All right then. So then I will go back to class now and get on with the subject. So this was the sheet I downloaded. Hold on. How do I? So this was the margin problem which we guys did. Yes, all of them have been put in Excel. Okay. Hold. How do I download this?
So when you click on the file, right, there must be an option.
Normally it says you download it.
Yeah. So yeah, these three dots, right? You can see. You can maybe. No, it's not there.
Normally it will just light up and hold on. I don't want to open with any other thing. Anyway, never mind.
Sir, you can open in Google Sheets.
Oh, download and go open with Google Sheets, you mean?
Yes, yes.
Okay, we'll see. Oh, okay. Never mind, students. It's okay. I will wait for other things. So no issues. Anyway, you guys have it, so no problem. So any questions you have, students, any issues? Anything else to discuss?
Sir, one thing, in that IQ options website, right?
Yeah.
We don't have any Indian company listed there. I mean, it's only, I think, the international stocks,
Yeah.
right?
Yeah. This is more international. But the reason I chose to go with that and not our NSE platform is the Indian market you can always analyze through any number of forums. Like if you go through moneybuy.com, there's a game you can play, a virtual game of investing in Indian stocks. But the global context is necessary from a derivative standpoint because all the things you see there are futures contracts. Bitcoin is a futures contract. The currency is a futures contract. And you, I think in other classes do not get a global asset class exposure, right?
Right.
If I'm correct.
Yes, sir. Yeah.
Yeah.
That's
So
right.
I just wanted to make it that way. So you guys have an idea of what are the global asset classes out there. And there are quite a few. Yeah. So that's why we've gone with it. Yes, Indian stocks are largely missing in that one.
Yeah.
But the one thing I like about this site is that it keeps a record of all your trades. So you can go back and look at it.
Yeah. That's right.
Okay, now, so I think I have completed, where did I stop now? Okay, so all this I covered, long hedge and short hedge we discussed. So let's see how we can apply this. Okay, so the first example, heading is spelled wrong, it's hedging. So hedging without basis risk, right? So basis risk happens when there is a difference between the spot and futures price, and this difference changes over time. There will always be a difference in spot and futures price, but sometimes this difference can either increase or decrease, and that causes basis risk. So let us look at a situation. Yes. Where you are selling basically some amount of sugar. Yes. The sale price is given. Yes. You also have a September futures. Yes. So contract, which you can use for hedging. So you have to come up with a hedging strategy. Remember, this company is selling sugar. So what does it not want to see? It doesn't want to see.
Price down.
Price decline.
Yeah, go ahead. It doesn't want to see what?
They doesn't want the price to go down.
Price to go up, actually, right? It's already selling, right? So the point is, if you are selling now and the price is higher later, then you sold too soon and you sold at a lower rate. So if I have sold something, yes, and I think the price may go up, what can I do? I can buy a futures contract to hedge. Yes. So if the price goes up by any sort of imagination, what I will lose by already selling, I can make up from the gain in the futures contract. Is that fine? Are you understanding the logic?
Yes.
Yes,
So
sir.
I already sold sugar, so I'm going to hedge by buying a futures contract. Okay, so that's what we will do. Okay, so okay. Now, in this case, okay, students, the company needs to sell 100 mega tons of sugar, yes, in the future. Yes, so let's read this question one more time before I okay, so the company actually needs to sell sugar by September 16th. Okay, students. So I will rephrase what I said. I think I read the problem a little different. The company needs to sell sugar in the future. Yes. So it is negotiating a contract on June 15 to sell sugar in September. So it wants to sell sugar in September. So what it is actually worried about is that if they don't sell now itself, the price may drop, right? Yeah. So what they want to do is they will sell sometime down the line and take a September's futures contract, sell it now. So what are they trying to do? They're going to lock in the price of sugar now. So if they lock it in, if the price of sugar falls, they will still get whatever price they locked it. That is the logic. Okay. So are you following the logic again, students? I am rewording what I said earlier. Yes, the company needs to sell sugar. Basically, so they don't want the price of sugar to drop between now and September. Yes, so they want to lock in the price of sugar. So what they do? So they will sell 10 September sugar contracts. So if we sold, what is the value of the September futures contract? 1510. Yes. So if the price is 1470, what will happen? You will gain 1510 minus 1470, 40. Yes. But yes, the spot price will also come down by 40. Okay. So the loss in the spot price is being offset by your gain in the futures contract. Okay, students? Are you understanding?
Yes, sir.
So that's basically the logic. Yes. Okay, now let's look at the second situation. If price is 1565. So in this case, yes, in this case, what is going to happen? You are going to lose money on the futures contract. You sold it at 1510. You'll lose about 55. Okay, students. So the new spot price, however, the spot price of sugar would actually increase by 55. Yes, but since you sold it, you can only get 15.10. Okay, students, and you will lose about 55 in the market. Are you understanding?
Yes, sir. Yeah.
Yeah. So basically, that's the chance you take. Let us assume you think the price of sugar is falling and you sold it. So you locked in the price. You are afraid it may fall. So 15.10, whenever if it falls, you are okay. But if it goes up, you'll still have to be satisfied with the 15.10 you got. Yes, it may go up also, right? Yeah. So why do companies lock in the price of sugar? Because they want to make sure that who sells sugar. This is companies that are exporting sugar, for example, right? They want to make sure they get that kind of amount, because if they are exporting and they are selling it to somebody who's an importer or somebody who's buying from them, he will buy at market rate from them, right? Whatever is the market rate, he will buy from them. Yes. So if the market rate is low at that point of time, then the company will be losing money by selling at a lower rate, right? So hence they lock in the price like this. Is that clear?
Yes, sir. Yeah. Sir, what is the meaning of this term basis risk without basis risk?
Okay, so basis is nothing but the difference between the futures price and the spot price. Remember we were talking about contango and backwardation and all that?
Yeah, yes, sir.
So basically that. So what happens is, usually there is a difference between the futures price and the spot price. Here you saw, spot price is 15.50, futures price is 15.10, right? Things like that. So this basis will keep changing. So sometimes initially it might be a small basis and later on the basis may increase, which will increase your cost of the hedge. So that is why there is basis risk. Are you understanding?
Okay, yeah, yes, sir.
Yeah. So it is nothing but the difference in the basis is nothing but the difference between the spot price and the futures price. Is that
okay? Yeah.
okay? Now, how about if we hedge and we have to take care of that basis risk also? So in this case, we not only want to lock in the price of the euro, yes, but we also want to make sure that we are not impacted by basis risk. So how do we do that? Okay. Okay. So what are we going to do? So we are basically going to sell one June futures contract. Remember, we are receiving euros, right? We are going to receive euros. We are selling something to a German company. We are getting euros. So what do we want? We don't want our euro to fall in value. Is that right? Yeah. So what are we going to do? We are going to sell euros at 0.0166 and basically lock in this price. Okay. So what we do? So we are going to sell our June futures contract at 0.0166. The spot price is 0.0160 futures price at that point of time. Remember, there are two futures contracts in question. At the end of May, June is when our euros are coming. So we are looking to lock the price of euro in June. Okay. Right now, spot price is 0.0160. Futures price is 0.1062. So what is our basis? Spot minus futures, that minus 0.002. So your gain on futures. What is the gain on futures? You already locked in the price at 0.0166 by selling the June contract. So gain on futures is 0.0166, add the basis to, June futures contract, which you sold, minus the May futures contract, which is 0.0162, that is 0.004. So basically, whoever the hedger is who has locked in the price of euro is basically going to get what? The June futures plus the basis, yes, which is also nothing but the May spot price plus the gain on futures. So you just add the gain on futures to the current May spot price, which is 0.100. So the check is those two things will add up to end up being the same. It will either be the May futures plus your gain or your June futures plus the basis. Both of those things will be the price. So 0.0164 is the price the hedger receives, and he is protected against basis risk. Yes, students, is that clear? Any questions? Questions, students? Any questions?
No, sir, it's clear.
Okay, fantastic. All right. Okay. Now, how do we decide how many futures contracts we need to sell or buy to hedge? Okay, for that there is something called the minimum variance hedge ratio. Okay, it is calculated using that formula you see, and that is how we calculate the hedge ratio. Typically, how many contracts I need to buy or sell to hedge? Okay, so let us do a problem on calculating hedge ratio, sample problem. I'm just walking you through problems so you understand these concepts and how you can apply them. You will not be asked any exam questions on these. My only form of examination is your assignments. So how many futures contracts should I hedge is the question, right? So let us calculate using that formula you just saw. So hedge ratio is this. All the values are given in the question. Yeah. Yeah. So your hedge ratio is calculated using that formula. Yeah. Directly given in the question. 32 sigma S is given as 32. You can go up and check. Yeah. Which is change in the spot price, standard deviation of the spot price. Sigma F is the futures contract. So correlation coefficient is given as 0.8. So you'll calculate the hedge ratio. Okay. So how many contracts need to be bought? So basically 2000 bales of cotton. What is the lot size? 50. So 2000 divided by 50. Normally people will just take 2000 divided by 50 and say you need 40 contracts, which is not correct because you will be over hedging. You should look at the hedge ratio and multiply that. Okay. So number of bales of cotton divided by the lot size would be 40 and you multiply by 0.64, which is the hedge ratio. So you never want to over hedge and overpay. So first you will be overpaying, and two, you will be sometimes over hedging the price. Yes. So you don't want, you want to be exactly hedged so that you are not, your hedge doesn't kill your profits, right? So hence, very important to calculate the hedge ratio. So multiply the hedge ratio with the number of bales divided by the lot size, you should get the number of, always approximate to a whole number. Is that clear, students?
Yes, sir. Yeah.
Okay. This is very important. If you are a portfolio manager, if you think your portfolio is too risky, yeah, how do you reduce the beta of the portfolio? Yeah. So you can do that. You can reduce the beta of your portfolio by selling futures. Yes. So you know about beta, students. What do you know about beta of a portfolio?
Beta is basically risk. In simple terms, it's the risk for every company or a organization in comparison to the market.
Very true. So it is essentially market risk. Okay. Right. So you can't basically hedge yourself against market. There are two risks, right? What are they?
Systematic and unsystematic risk.
So beta is what? In that, what you said?
Beta is a combination of both, actually.
No, beta is systematic. Beta is a measure of systematic risk. Okay. Unsystematic risk is company specific risk. Okay. So if a risk is inherent with, say, Satyam and it collapsed, that is company specific risk. That is unsystematic risk. Now, if you add systematic risk and unsystematic risk, that is captured by total risk. So your standard deviation of a portfolio captures both systematic and unsystematic risk. Yes. Now, which risk can you protect yourself against ECL? Systematic?
Systematic only.
Systematic only.
No, actually, unsystematic, you can protect yourself easily against. Why? You can diversify. Yes. But systematic risk is, give examples of systematic risk. It affects the whole system, right? You basically can't protect yourself against that. So recession, example of systematic risk. Inflation, natural disasters, earthquake, tsunami or something. When these happen, some systematic risk can happen, right? Inflation, all these things are examples of systematic risk. War is an example of systematic risk. Ukraine war immediately impacted everybody. So you can't protect yourself easily because you don't know when it is going to happen. But you can hedge yourself and reduce your portfolio's risk so that when systematic risk happens, your portfolio is not impacted as before. Are you understanding the logic?
Yes, yeah.
So what does it mean if I say the beta of my portfolio is 2? What does it mean?
So we can relate it to volatility. I mean, how it moves in accordance to the market. That's what beta is, right?
Correct.
The fluctuations. Yeah.
Correct. So basically it means if the market goes down 1%, my portfolio will go down 2%. Yes, market means what? Market index like Nifty. Yes, so a beta of 2 means if my market index goes down 1%, my portfolio will go down 2%. So my portfolio is twice as risky as the market. Similarly, if the market goes up 1%, my portfolio will go up 2%. So high beta is good when the market is in a bull trend. But in a bear trend, high beta, like right now, in the last 4 years, last 6 months or so, high beta is dangerous in a down market. So you want to stay with low beta strategies. So how do I do low beta strategies? You can buy FMCG, pharma, etc. Or in general, sell Nifty contracts and hedge your portfolio and bring down your beta. So that's what we're going to look at. Okay. So if the portfolio is P, yes, and I want to sell, I can calculate this as P into beta P minus beta D is the desired beta and divided by the value of the futures contract. That will tell me how many contracts I need to sell. Okay, have a look at this. So here is a situation where the beta is 1.2 and I want to lower it to 0.9. Why do I want to lower it to 0.9 is the larger question. Because I feel a market is going to go down. In January 2022, if I had done this, I'd be very, very, very happy. Correct? Because I have lowered my risk. Yes. My portfolio, if Nifty, I think is down how much this year, students? I think at least 15-16% it is down, right? Yeah. Am I right?
Yes, sir.
Let's look.
It's nearly 20.
Nearly 20, right?
Yes.
US market is down even more, which is surprising to me. Normally, when US market is down 20%, Nifty will be down 30%. That's why I think this is not done yet, right? So we will go one day. Maybe we make it. So 22, we are, yeah, we're here. We're somewhere here. We were 18,000 something there, and now we are 15,700. So it has been what, almost 17-18%, like you said, we are down. Okay, so the best thing to do is in January, if I had seen something like this, I would have reduced my beta by selling something. So how do I sell? Yes, my portfolio is 20 lakhs. Yes. So now the lot size of Nifty is 50. So I'll just sell. You can see now you don't need that many contracts to sell, because Nifty has gone up in value. Back in the day, Nifty was only 5,500. Now rework this calculation, students, and put today's Nifty value of 15,700 there. See how many contracts you need to sell. 700 instead of 5,500. Put 15,700.
Okay.
What value you come up with, students? Almost 0.8 or something it comes. If you approximate, one contract would be adequate, right? Am I right?
It's 0.76.
Yeah, 0.76. Yeah. So 0.76, you approximate that to the next whole number, it will be 1. So I can just sell one Nifty contract and hedge this portfolio and reduce my beta from 1.2 to 0.9. Yeah. Yes, students. So the more I sell, the more I will reduce. So you, as a fund manager, you have to take the call. You think it's going to be a correction or a crash? If it's a crash, I'd like to sell more Nifty contracts and say I'd reduce my beta to 0.7, 0.8, like that. But if it's just a correction, I might say, okay, my beta is still high, just bring it under 1 and let's just watch the fund. Is that clear, students? Yeah?
Yes, sir.
Yeah. So this is one way of reducing risk in your portfolio. Right now, I would definitely consider doing that if I have a big portfolio. Yeah. Okay, students. Now let's go to YouTube. Do tell me if these audios are creating any difficulties for you. Okay, this was for Friday. He didn't do one for so let's see what these guys say.
₹65. So like really mad day for me. It's hilarious, right? No matter what positions they are, right? And I think I did all that Gyanbazi and I did this today. Uh, so somewhere in the oh my god, where is that? Sorry, somewhere in the morning today, I think I did this. This is the only trade. I mean, one of the two trades I did today. So around 11:19, I bought 15,800 put ITM option at 187 rupees, and I got stopped out at 180 rupees. I think 4k or something damage, right? Of like roughly 7 into 450, roughly around 4k damage. Then it went to 430 rupees and eventually it settled at 265 rupees. So like really mad day for me. It's hilarious. Uh, yeah, I mean I'm in such trauma that I'm wearing this sweatshirt, like how people who have just got out of like a accident and all put blankets, right? I mean, so Raj is asking for Hindi. Raj, if you want a Hindi broadcast of the same thing, you can go to Sensible channel. Sagar does a wonderful Hindi show every day. So you can go to Be Sensible. There is a Hindi broadcast of the same thing, same analysis, same everything, different face, slightly bit of face, and you can watch it in Hindi, right? So, uh, so yeah, crazy day, and but at least, right? I mean, I'm looking at Twitter and I'm hearing stories of ghastly loss. Log bol rahe 50 lakh उड़ गया 10 lakh उड़ गया, and I'm like, boss, what is this? Uh, I mean, at least. So here's the thing, right? I don't know if I'll have that kind of a day on an expiry like this. Um Primarily because I bought uh, 450 lots of 450 quantity nifty options today, and my hypothesis of course was ki yaar, if I get a lottery, I get a lottery, right? And I put a 10 rupees stop loss, but I should have put slightly deeper stop loss, 20 rupees maybe. I mean, seriously, I could have taken a 9k loss. I don't know why I didn't take 20 rupees stop loss. I put a 10 rupees stop loss, and I got stopped out. Some complex logic and all I did. 10 rupees in options uh, is 20 rupees delta. So 20 points in underlying is my stop loss. Therefore, 10 rupees in option. I did some stupid logic and I, did all of that. But anyway, that it's not about that. But uh, uh, Akshay is asking, can I send some features? Yes, Akshay, you can send it on abid@sensible.com. Uh, Pranav is asking what explains so much volatility. So let's look at what actually happened today, right? And it's important. So yesterday we talked about it, right? We said that this is a make or break zone. We had talked about why Nifty is likely to be volatile. Uh, because Varun, you're asking a very good question. I'll take that question also, right? So So basically it went up and it came down, it tried to break the channel, it tried to make the channel. Every time we are near a point of make or break, uh, especially near channel borders and all, this kind of volatility happens because nobody gives up the last post without a fight. I mean, think about it, right? This is going to be the Nifty Bulls ka last stand. If this breaks, we are going to see 14,400. They are not going to give up this fight easily. At a very fundamental level, supports and resistances are not going to be easy places to, um, what do you say, trade, simply because there is going to be volatility. Now, of course, if it goes
Let's
higher,
pay attention to
right,
the audio, the video.
once we find some kind of a movement with some kind of a volume, then of course it will trend in one direction. But till that point, you have to be very careful what is happening. So without further ado, let's forget about what happened today. Let's look at what is going to happen tomorrow and how should we react to what the market throws. Now tomorrow is the weekly expiry, right? And this is very important. So what do we know so far? One, we have seen a trend line here. We have seen, and I'm pretty sure now that this is the bottom of the channel, right? I'll tell you why I'm sure this is a correctly drawn trend line. Of course, there are multiple points at which it bounced. I also know that there have been two occasions when it tried to go under and tried to consolidate and came back. I also know that yesterday it tried to break in the morning, but it held. And today I know that the bottom of the trend line was today's low also. So this is the, like, make no mistake, this is the support zone. This is back into the channel, right? Now we are back into the channel, right? This means that it doesn't make sense to short here. Maybe it makes sense to long with some light positions, but I don't think this is a shorting market, especially as long as the channel is holding. I'll tell you why you should get out of the shorts and should not be further long at this point. Look at this, right? This is a weekly 100 weekly moving average, not 50, 100 weekly moving average. This is a bearish harami formed on a weekly time frame. Now, if Nifty is going to go up further, then the harami becomes weak because ideally haramis have to be really tiny. So if tomorrow is a strong close, let's say it closes around 15,700 or 15,750 or something, 200 points up, then it's not a great harami, right? And the other problem, of course, is that, oh, so this is going to be very interesting. So I think I'll need an Excel sheet for this, but let me just write it out. First, let's draw all the critical levels. So horizontal line 15,700 is one line, correct? And this is of course another line. This is supply zone somewhere around 15,900 odd levels, but we are not looking at 15,900 now. 15,900 is far away. 15,700-ish seems to be some level where there is some action happening, right? Now the catch is, if Nifty bounces up tomorrow and closes at 15,700, what all will happen? We'll get a kind of a bullish harami into the channel bottom above the 100 weekly moving average, which will make everything bullish, right? And at that point, there's no point in holding on to a short. Get out, save your life, right? No questions. I mean, it's stupid to stay short after that has formed. In fact, even if tomorrow is a negative close, let's say we have a 15,475 or 15,500 or something close, slightly negative close, this harami actually becomes stronger, because for a bullish harami, what you need is a very tiny green candle after a long red candle. So a weaker close tomorrow will actually make the weekly candle for close stronger. It's thoda ironic, I know it's thoda weird, but a good harami has a very small body. And as of now, this body is thoda mid-sized. In fact, tomorrow if it's really bullish, right, then it's going to be really tricky. Then we don't have a good harami forming. If tomorrow closes at 15,850 or 15,800 or 15,700 or anything, 15,750 or something, then the harami is not very clearly formed. For a harami to be formed, it has to close somewhere near 15,500 or below, right? So that is a weekly candle, what it is looking like. Now let's look at monthly candle also. Monthly candle is still a big negative candle. There's nothing much to do there. But the critical levels are somewhere around 1500, 15,650 or something, there is this horizontal level, which is also coinciding with day before yesterday's close and today's high, right? So today's high and day before yesterday's close are somewhere around 15,700. That's a level to watch. If it breaks, then we are back into this supply zone. But then again, just going back here doesn't mean anything, because you have to cross this supply zone to be really, really bullish, right? So at this point, you can be halka sa bullish because it can go all the way up here, but I am not sure if it will cross this zone, right? So I'm not going to be short, I'm going to be halka sa bullish. The problem why I don't want to be massively bullish is because I'm not sure if it can cross the supply zone between 15,700 and 15,950, right? This supply zone, I'm not sure if it will be able to cross 15,700. Forget 15,700, right? Even 15,800ish, 15,850ish, right? So let's say that there is a resistance from 15,700 to 15,850. This is the level we have to watch. But having said that, if the 50 WMA holds and the channel bottom holds and the bullish engulfing is forming, it's necessary that we take at least some small bet, and it is very, very necessary that we at least don't stay short, right? Because when a bullish pattern is forming, you have to take a long. And but you will say that what about the resistance here at 15,700 to 15,850? The catch is you can short the resistance only if it is backed by uh, price action, right? So short only if price action bar candle comes. So till a proper price action candle comes at the resistance, there's no point in shorting. Now let's look at option chain. And this is again very interesting analysis, because option chain today, if you look at it, there is not much of action, right? I mean, there is some here and there, some put writing, call writing. 15,700 there's 1 million call rating, but otherwise there's nothing, right? There is 17 million calls for 15 million puts, but most of them came at this area, which is 16,000. That is doesn't count, it's nowhere near the ATM. But if you look at action from June 20th, that is Monday to today, you'll see that there's a lot of open interest, 2 million open interest at 15,500, which also makes 15,500 like a significant OI. So 15,500 has around 7 million calls. This is a lot. And so let me just remove July. Even then it's around 5.5 million OI at 15,500. So obviously 15,500 is a support, and put call ratio is at 1. That is bullish. FII data is not updated. Let me quickly see if it is updated now. Nope, not updated yet. FI futures data is not updated. Stock data is updated. 2,300 crores sell. So this has not changed, right? The stock data is now exit longs if channel bottom holds and Harami confirmed. Sorry, exit shorts, not exit longs. I mean, can initiate limited risk light longs at this point. Also, but if close is weak, right, and Harami invalidated bar channel threatened, no longs enter short. So basically tomorrow morning you don't have to take a position, wait and watch what happens tomorrow. If it closes, somewhere near 15,350 or something, right? I mean, that's also 200 points away. It's not very difficult with the kind of movements market is doing every day. What is 200 points, right? So let's also look at it in a weekly time frame. If market closes around here, which is 15,350, then this thing becomes a doji cross. Then this 100 WMA is threatened and the channel bottom is gone, right? So a week closing tomorrow, not 50, it is 100 WMA, sorry, right? And this 15,500 support becomes resistance. The open interest at 15,500 will become a resistance if close happens at around 15,350 levels, right? Watch 15,350 levels, because if it is holding around 15,450, 15,500, etc. levels, then it is going to be long only. But you shouldn't do long with naked futures and all, because technical analysis doesn't work 100% of the times, and galti se, if this is that 20-30% times it does not work. If you're long futures and if this channel breaks, it is going to be massive. So long trade to be done with bull call spreads. Why? Because limited risk with light position. If weak closing, short trades can be slightly bigger, because the downside is significant. Nifty will just continue with the long-term trend of down. That said, let's go back to Bank Nifty. Now Bank Nifty is again closing above the middle of the channel. Again, optimistic case looks strong. Let's look at weekly candle of Bank Nifty. Oh, this is a curveball, right? Proper curveball. Because on the one hand, it is a bullish harami. On the other hand, it is below the 100 weekly moving average. Mixed signals, but if tomorrow happens to be a positive day, it can close above 33,300. So above 33,300, it gives a close. It's a bullish harami with a close above the 100 WMA, which means that it is a long opportunity. And because it is going to be a big move, you don't have to take big positions. You only have to take light positions, because in a big move, light positions will capture a lot of points. You can do a spread of 33,500, 34,000, or 33,500, 34,500 spread, or 33,500, 35,000 spread. Any kind of call spread is a very good idea at this point, right? And it can have an upside till 34,500, which is the gap. So, but then the only counter argument to this is you have to watch this trend line which we are drawing. But यार मुझे नहीं लग रहा that's a proper trend line. Let's just remove this, right? Every day sorry, every day I draw this and I remove it anyway. So Bank Nifty is forming a bullish harami above the middle of the channel and threatening the 50 WMA. If this happens, then you shouldn't be short Bank Nifty either. You should be thinking of halka sa long. Halka sa, because the overall trend seems bullish. Sorry, bearish. This is a long standing channel. This is a long standing channel. All of these are bearish, and it's very difficult for us to bet on the reversal, right? When you're betting on the reversal, you should always take lighter positions, because if this continues and it breaks the channel, then it is going to be mad. Also, let's not forget that there is this supply zone here. So net long trade to be done with bull call spreads, or even bear put spreads. I mean, bear bull put spreads also you can do, because weekend theta earning. But it's not very clear till tomorrow's closing what to do, and there are no points for predicting. We can take a trade tomorrow very close to 3 o'clock or something to do our trade, right? But there's one thing which is very sure: straddle is probably the worst idea, because no matter what you do, this is going to go somewhere. Now it's at a proper make or break zone, and let's face it, right? Everybody who sold uh, straddles today would have gotten properly whacked, right? So there's no point in doing that straddle selling either. Now let's finally look at USD INR. USD INR on domestic charts. Let me just open the domestic chart for USD INR. So this so this is the USD INR, right? Now the The thing with USD INR is yesterday it gave a bullish engulfing. Today it gave a confirmation also. But today when it opened, it went negative and it kind of invalidated the confirmation, and today it closed below yesterday's high. So I had USDNR calls long, but because their calls and time is running out, I kind of closed it at some marginal PNL. But I wouldn't want to stay in USDNR with any instrument which involves theta decay at this point, simply because this is not showing momentum, right? Because after coming here, this could have easily broken out, but it did not break out. Now here's another angle which I'm thinking through. If USD INR is nearing its peak, right, by any possibility, then USD INR can go down, and that stuff usually happens when Nifty has positivity, right? So basically, if there is a reversal on Nifty coming here, USD INR will have some gains. Basically, USD will fall, USD INR will gain. So that could mean that risk is going away from market, and it could mean a strong Nifty, strong bank Nifty, and a weak dollar. So because of that reason, I am thoda getting out of um, dollar. It looked like it was really making a strong run, but somewhere near the top it is not. But still, if you believe in the negative case that if dollar breaks, it will break in a big way, then you should be long dollar. But you should be long dollar probably in instruments which have big small theta decay, right? Now that is usually either a call spread with long 10. So let's look at that instrument, right? So if you want to be, so let's say your hypothesis is that dollar shayad fatega, and if it breaks big time, I want to capture that upside, but I'm not willing to pay theta till that thing happens. So what do I do in that case? I take USDNR, I take a bullish call spread, and I want a trade that will not lose much even if the market goes against me. And that trade is a long term option. Bull call spread in a long term option. Now look at this trade, right? This hardly has any theta decay. I mean, almost zero theta, 2 rupees ka theta decay. Even if I were to multiply it by, oh, it's multiplied by lot size. So let's say I take 100 lots of USDNR, this spread, right? 78.25, 78.75 spread. I'll lose like 200 rupees over the weekend, right? And let's say that I am wrong, that dollar went to 78.10 in another 4 days, right? My loss is only around some 6k. Now this is something I can play for it, because if I'm betting 100 lots of USD INR for an upside as high as 26k, I should be able to take a 6k ka MTM. And the good news there is, if you're betting on a large move and if it goes against you early on, you're not going to lose much if you're going to do a spread, especially a spread with enough number of days left to expiry, because that is going to have very low delta. Basically, if you take a spread with long number of days to expiry, the MTM you get if the trade goes against you will be very minimal, right? Because that's how the delta of spread acts like. So if you really want to bet that dollar kabhi na kabhi to fatega, if you are under long dollar without taking too much chances, then probably you can do this trade, because even if you're wrong and dollar fluctuates a little bit, let's say by Tuesday it fell, or by Wednesday it fell around uh, 15 paisa, this is going to let you stay in the trade with a MTM that does not stress you out. But because all of us are seeing a make or break zone, right? Because this is a level for Nifty which we have to watch out. This is a level for Bank Nifty which we have to watch out. This is a level for dollar we have to watch out. I would say that once the confirmation comes, it's a better idea to trade. Now the catch is, it's very easy to say that boss, अब तो ऑलमोस्ट पक्का है कि निफ्टी ऊपर जाएगा, चलो यहाँ पे छोड़ देते हैं, लॉन्ग मारते हैं आज सुबह, आज इवनिंग. द प्रॉब्लम इज दिस, राइट? We have seen at least 3 Fridays in the last 3 months when Nifty sold off in second half of Friday. Now, if something like that happens tomorrow, 100, points, then all of this bullish harami and all goes out of the window, and we are into proper bearish territory. Or look at it, right? So let's say tomorrow there is a minor sell-off, right? Let's say 200 points ka sell-off. We'll see 15,300 types. This bullish harami, which is under formation on weekly, will become a shooting star with a rejection wick from the supply zone. The entire view changes, right? Right now we are in bullish harami, and a 200 point sell off tomorrow, which is just around 1% and a quarter, will make the candle completely different. So which is why I'm saying it's a bad idea to take a trade based on a weekly candle till that candle is fully formed. Um, Dutch Misa is asking, should we look at other parameters? Yeah, you can look at any parameters you want as long as you keep the parameters limited to a small number. If you look at a lot of parameters and trade, then it is going to be cognitive overload and it is going to be very confusing. But if you're so the thing is this, right? I look at these things and trade because it's simple to understand, simple to debug, simple to explain, simple to make peace with. The problem with RSI, stochastic and all is I don't understand them deeply at a very deep level, right? Because at the end of the day, RSI is a derived number coming from something, something, something. It is not coming from pure price action. Like if I look at open interest and see a huge OI, I'll say ki boss itne log khade hai. If I see FII data and see that they are selling, I'll say FII is. The problem with RSI is that I'm like, boss, what is this RSI thing, right? I mean, I don't really know. It's coming from some uh, relative strength, momentum based mathematical number, which I have no idea how it works. I mean, somebody would have made the theory saying that, okay, this shows the trend of this thing, but I can't really, make peace with that. That's why I don't trade it. But if something works for you, of course, you should do that as long as you don't, do too many things. So Sagar is asking a question, how to stop over trading. Sagar, it's a beautiful question. I'll just quickly, sensible blog, how to, I think, I think we had written an article on how to control impulsive trading. Let me just see if we have this. Da, 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 but I had this article written on how to uh, 14 tips to improve your trading. I don't know why spotty 14. Then I had written something on uh, 13 ways, 14 and 13 ways to improve trading. You can just go through this. I mean, there are some decent articles here. Mostly, okay. So I'll give you one tip, right? If you feel like taking a trade, take 10 deep breaths and literally sit on your hands, right? Don't leave your hands free. Just sit on your hands, you know, and literally sit on your hands, right? कि आपका हाथ ना चले कीबोर्ड के ऊपर. Take 10 deep breaths, take like wait for a minute or two and then ask yourself, do you still want to do the trade, right? I mean, this is something I do personally to control buying stuff, whether buying stocks or buying financial assets or buying, buying like a radio controlled toy, right? Basically I ask, if I feel like buying something, I say okay, if I still feel like buying it next week, I'll pakka buy this thing. But if I don't feel like buying this next week, I'm not going to buy this thing. I mean, I know that next week is a very big time frame, especially for option trading. So let's cut it down, right? Just give yourself time, take a deep breath. 10 minutes wait karo, फिर आप सोचो कि do you want to still take this trade? If you don't feel like taking that trade after 10 minutes, then don't take the trade. I'll give you one more tip. Don't take a trade tomorrow if it is occurring to you only tomorrow, right? Take the trade only if you thought of it like yesterday or day before. Like all these trades I'm thinking of, right? I somehow have a feeling ki boss, you know what? I'm waiting for this trade. I'm waiting for this trade. I'm waiting for this trade. I don't take a trade because उस दिन सुबह सुबह मेरे को feel आया कि boss, this trade I'm gonna do, right? If this trade is something which occurred to you earlier, or if this trade is something which you have planned for, or if this trade is something which you want to do 10 minutes after you felt like first thinking of something, then do the trade. Otherwise, don't do the trade. S is saying that kill switch. Of course, some of your brokers do give you kill switch. If you have a kill switch, brilliant. Whether you had a big loss or a big profit, if you feel like that, boss, ho gaya, I don't want to do something neurotic, please use your skill switch, stop trading, take a break, right? That's one way to stop over trading. Uh, yeah, I think that's that. So in any case, that is that. So let's see. We are done with dollar. We are done with Nifty. We are done with Bank Nifty. Net. Tomorrow's candle is a weekly candle. It is going to be crucial. Let us take the trade when we know what is happening. Right? Let's not jump into a trade without clearly understanding the situation. And as we say buy, let's just look at our unreliable indicator, which is SGX Nifty. SGX Nifty, which is 15,548, which is pretty much flat, right? It's neither up nor down. So we'll see tomorrow what is the action. Um, So on that note, I'll take your leave. We'll see you again on Sunday night. This is not tips or what's that thing called? Advice or recommendation or anything. This is just purely analysis, not for educational purposes, because of course
So based on what he said, bullish action has been confirmed, right? So he basically said that. So something like Harami pattern or something he's talking about. So action seems to have gotten bullish. But please understand, the market fell 2 weeks straight, right? So it was due a rebound. So in a bear trend, these bear market rallies can disappear just like that. So that is something you need to worry about. So unless if you make profits on the long side, take them quickly. Do not sit on them, because this ultimately is a bear market and it is going a lot lower. Any queries, students, on what you were saying? Yes? Any queries?
No, sir. So the indication was slight bullish, right? So from long-term perspective, I mean, we can take a long position, right? For long-term
Short
perspective.
term, very short term bullish, not long term.
Yeah, that's right.
Yeah, so maybe for a week or so bullish, but once you make any money, get out, because I think this market can quickly turn from bullish to bearish in very short notice. In fact, I think it's on the verge. I don't think so. One of the things he said clearly was 15,850 to 15,950 is major resistance, right? So we broke those levels. I showed you on the monthly graph on the Nifty, right?
Yeah, yes, sir.
Remember, I showed you this, and this is Nifty weekly. You can see how the lower Bollinger Band is acting as support, 15,370 on the Nifty. So that means it can push it up, yes. But if you look on the monthly graph, same graph, it just broke that monthly trend line, the red line. So that red line you see, 15,962 is possibly where the next rally will be finished. And after it, if it gets a rejection there, you can see a very fast fall back to this lows here. Yes, students. So you can see how every time the Nifty has been, what it has been doing, it falls, it hits the lower Bollinger Band, forms a bear flag pattern. You see a inverted flag forming there, students?
Yes, sir. Yeah.
So look at the left-hand side of the graph, all the way from the top. The market went, touched the blue line, formed a inverted flag, crashed. Formed an inverted bigger flag, crashed. Form another inverted flag now. So my guess is 16.9 to 15.2 now, right? So another 1,500 crash points it is going to do. So the point is, I would rather play for a crash in July on every bounce here rather than try to make the next 200 points up, because the trend is down. So does that make sense?
Yes, sir. Yeah.
Yeah, so always go with the trend. And I don't think the trend changes to up suddenly after it has been down for so long. So my guess is that red line you see there is all she got in the short run. If it gets anywhere close to the red line, sell it. Yes, and what I will do is sell stocks that are weaker than the market, like the metal stocks, which are collapsing much more than the market. When you want to buy stocks that are stronger than the market. And when you want to sell stocks that are weaker than the market. So Monday will be interesting. I think, let's see, I think it will open near 15,850 or something. And the previous high here was 15,860. So if this does not eclipse, then I think that will probably be that. Yes, so will be interesting to say the least. But be careful if you are long, because most of the long move has already happened, maybe 200 points left. That's why you're saying take small long position if you're that.
Yeah, yeah.
Yeah, he was saying that this green candle forming the weekly chart is bullish. Yeah,
No, sir, nothing. I was just.
okay. Okay, students, any questions on anything else discussed so far? Or? Anything on hedging, hedge ratio, all those things? Okay. Okay, this. Okay, now more on hedging. We just talked about hedging and reducing the beta of the portfolio. So how do I find out the exact number of contracts to hedge if I were going with the beta of the portfolio, right? So in this case, what are we going to do? We are going to calculate the ratio as beta into VA by VF, where VA is the value of the portfolio and VF. Instead of the hedge ratio here, we are going to be using beta of the portfolio. Okay, students, so let's look at that. So this is back in the day when all those stocks were very low in value. So, but have a look at this. So in this case, you are hedging a portfolio that contains Reliance with Nifty. So you have basically Reliance and you think short-term market is going down. So you are hedging by selling Nifty futures. Okay, students. So how does that work out? Let's have a look. So this is basically saying that why would you do this? So this is basically a market neutral strategy. Basically, I'm saying that Reliance is going to do better than the market. So if it falls, I'm only going to take away market related risk. So, but in this case, Reliance actually is more risky than the market. So if it falls, actually it can fall a lot more. So at times when you feel that Reliance is going to fall because its beta is greater than 1, it is better to hedge. Okay, so hedge with Nifty. Okay, all right. And if you are not sure whether it will go up or down, then also sometimes hedging may make sense. You are not very sure because you think that if Reliance goes up, it still has a higher beta, it will do better. And if it falls, it will fall a little bit more. So you have a hedge. Okay, so these in these circumstances you can use hedges. So have a look. So let's look at scenario 1. Back in the day, lot size of Nifty was 200. Now it's only 50 because Nifty's value was very less back in the day. Okay. So what is our value of Reliance? We have 2,000 shares into 540, whatever that value is, 10 lakh, 80,000, whatever. And Nifty is contract is 20 into 8. So the hedge ratio here is calculated as beta into value of the portfolio divided by thing. So we sell 4 contracts. So the first thing is to find the hedge ratio, which is calculated this time as beta. The previous time we calculated it based on the correlation coefficient, etc. In this case, we are calculating it based on beta. So if you do that, it will work out that you will have to sell 4 Nifty futures contracts. When you run the calculation, do you get that? You get it near 4, probably exactly 4 you will get. Yes, students? So basically, if I sell 4 Nifty futures contracts here, I will be able to hedge this portfolio. And let us work out the scenarios. Okay, so what will happen here? If Reliance goes up and the market goes up, your gain in Reliance will slightly be offset by loss in the Nifty futures contract. Yes. So my loss on one contract is 890 minus 1960, but you have sold 4 futures contracts, lot size is 2000. So if you do that, you will get a loss on futures of 56,000. So gain in Reliance is 70, which is 1.4 lakhs. So overall profit is your gain in Reliance minus your loss in the Nifty futures, which is 84,000. Obviously, you can tell me that if I did not hedge, I would have made more. So remember, hedging is only when you think the market goes down. Obviously, when you think the market is go down and if it goes up, you will lose some money in your hedge, right? As it happened in this case. Ultimately, you know it's going to go up. In case it goes down, this is the hedge works. But look at this. What happens when the market goes down actually? So if Reliance were to fall 500 to 500 and it loses 40, gain on Nifty futures is 80, total gain on futures is 64,000, loss in Reliance is 80,000. So net loss is only 16,000. Why? Because you hedged with Nifty. If you did not hedge, you would have lost 80,000. So you understand when it is good to hedge when the market falls. Yes, students?
Yes, sir. Yeah.
Yeah. Any questions?
No, sir. No.
Okay. So this is a good time to be hedged. Why is that? Because there's plenty of systematic risk from Ukraine, Russia, from central banks raising interest rates to controlling inflation. Loads and loads of systematic risk is there. So that is that. And at any moment, the market's trend is down. You're already down nearly 20%. And my guess is at the end of the day, this looks like maybe a 30 to 40% down here. So this is a good time to be hedged. So you hedge when you think the market, you simply don't hedge, but you hedge when you think every time the market may go down. And this is definitely one such time when the market is going down. So when you hedge systematic risk, if you think you can beat the market, like you are picking stocks that do better than the market, Market neutral strategy is what it's called. Then you can go ahead with the hedge. Okay, but it's always good to you have a sense of the market. So then you know when to hedge, when not to, when to reduce beta, when to reduce risk, etc. etc. Any questions, students? Any particular feedback or input that you want to have so we can position the class accordingly?
Hello.
Yeah.
Sir, one suggestion,
Yeah,
like about the videos that we go through in the class, if the
Yeah.
links can be shared with us beforehand, we
Yeah.
can go through those particular videos and content beforehand. And I think we can have better sessions and
Okay, so
practical.
so one thing you can do is on YouTube, definitely follow the Sensi Bull channel. That they post a video daily. That's a good thing to follow to get a good sense of the market. Yes, in YouTube, Sensible channel, because I can only show you the Friday's video. Each video is 15 to 20 minutes. So daily they will post an update. That's a very, very good video for you to follow to get a good sense of the market. That's pretty much it. Yeah. Rest all basics of the class, which I have discussed, I will usually play. But yes, if there's anything to share in advance, I will share it. Yeah. But do follow Sensible. They are very good.
Sure.
Their daily videos are worth watching, particularly those of you who are trading the market. Okay. Any other comments, questions? So this market neutral strategy is something some of the top fund managers in the world use, who are very good at stock picking. They think they can beat the market with their stock picking skills, and so then they hedge with the market index. Okay, so rolling the hedge forward. So let's say you are short, you are hedging with the June futures contract, but next week it expires. So what do? You have to switch from the June to the July. So that is called rolling the hedge. So when you roll the hedge, there will always be basis risk because there will be difference between the spot and the futures of the next contract. So yeah. Arbitrage can also be done in the derivatives market, spot and futures arbitrage. So particularly next week is a good week for arbitrage. Why? Because Thursday futures and spot will become one and the same because they expire. So if the futures contracts are ahead of the spot, you can buy futures, sell futures, buy spot, etc., and make free money arbitrage. Yes. So stock and index arbitrage, spot futures arbitrage. So sometimes you can also make stock and the index if you feel the stock price is way ahead of the index and come back to the index, then you can sell the stock and buy the index, etc. So arbitrage opportunities can also be seen in the futures market. Okay. So here's an example of potential arbitrage thing. So here's a situation. Is there a possibility for arbitrage? And if so, how are we going to act? Okay. So basically, December futures of rubber seems to be very, very high right now, 5650. So if I borrow, so what I want to do basically is I will sell December futures at 5650. Yes, and use it to buy rubber in the market right now. So you all know how to value a futures contract. We discussed that before. So what is it? So basically, if you buy rubber now, you'll have to store it somewhere, right? So you have to include that cost also. So you incur 8.5% for that, right? And you have to store it for 8 months, right? Remember, is that 8 months? Yeah, April to December. May, June, July, August, September, October, November, December, 8 months. Yes. So if you do that and you do the calculation, you will basically, yes, incur only 5628. But you already sold the rubber futures contract at 5650. 5650 minus 5628 is your arbitrage profit. Is that clear, students? Yeah. So basically, if you value the futures contract right now for rubber, yes, remember how do you value it? Basically, your value of the spot plus the interest incurred in putting the rubber somewhere, holding it. So if you do that calculation, you get 5628, but the futures contract is actually 5650. So better, it is a little overvalued. So if you do that, the theoretical value of the futures contract comes to 5628. So it's better you sell the futures contract at 5650 and buy rubber and hold it and get 5628. Difference is your arbitrage profit. Is that clear?
Yes, sir. Yeah.
Yes. Sir.
Okay. Now, so that's that for futures contracts. Okay. All right. Maybe I can. Next, what I'll do is I won't do swaps. I'll actually come to something called options, because the options market is very, very interesting. Many people get their feet burnt. I have done it time and time again, because they view that as a option market to make lots and lots of money. It is possible only if you take quick profits. And that's something that you should be very adapted and flexible to. You can make loads of money in options if you take quick profits. If you don't, you can lose loads of money too. So hence that is, but before that, let me see. My YouTube, I think I may have already played this video. You guys can tell me. Okay, so this is a very interesting video. This guy Kevin Bracker on YouTube, he puts down very good videos on derivatives and all these contracts. So I'll play a video on how futures are basically priced. So I already explained to you, but look at his insight is interesting. So I'll play that.
The double-digit numbers in my equity.
In this video, we're going to take a look at futures pricing. Now, ultimately, futures prices are set by supply and demand in the financial markets. You have people that want to buy futures contracts, people that want to sell futures contracts. And wherever the supply and demand meet, that sets the equilibrium price, and that's the price of the futures contracts in the financial markets. Theoretically, we could take a look at two different ways to price futures contracts. One is based on expectations theory, sometimes referred to as expectations pricing. The idea here is that the futures price should equal the expected spot price at the time of expiration. For example, let's take a gold contract. If I think that at expiration gold is going to be $1,500 per ounce, then I wouldn't want to pay $1,550 per ounce for it today. On the other hand, if investors thought that it was going to be $1,500 per ounce at expiration, they wouldn't want to sell it to me for $1,400 per ounce today either. So the price in the futures market should be equal to the expected spot price at expiration. Now, this isn't each individual's expected spot price, but the equilibrium expected spot price should set the value of the futures price in the financial markets. However, when we get into financial markets, we might see that there are some other things to take a look at. And that introduces the arbitrage pricing approach. To introduce arbitrage pricing, let's start with an example. Let's assume that you could buy a barrel of oil for $80 today. The current futures price for delivery 3 months from today was $85. How can you exploit this discrepancy between the spot and futures price in a world of no transactions costs? So, oil futures contracts are 1,000 barrels. So let's say I go out and buy 1,000 barrels of oil today at $80 per barrel. I can then at the same time sell a futures contract and agree to sell those 1,000 barrels of oil for $85. I've just agreed to sell the 1,000 barrels of oil I bought today for $85 3 months from now. So 3 months later, I deliver 1,000 barrels at $85 per barrel. I make a $5,000 profit. Now note, on this $5,000 profit, there was no risk to me. I didn't care what happened to the actual price of oil after I bought it, because when I sold that futures contract, somebody on the other side was agreeing to take delivery of that oil for $85. I bought today, locked in my sales price, and guaranteed myself a profit of $5,000. Now, in that example, we assumed a world of no transaction costs. However, let's try to move this to a more realistic setting. One contract of oil is for 1,000 barrels. What issues will I have when I try to take advantage of this pricing scenario? Well, first of all, remember my first step in the above example. I had to go out and buy 1,000 barrels of oil at today's price of $80 per barrel. What am I going to do with 1,000 barrels of oil? Can I put it in my backyard? I'm guessing my neighbors probably wouldn't appreciate that too much. However, a local thief might find it attractive and decide to come and take a couple barrels and turn around and sell them. So when I purchase my 1,000 barrels of oil, I have to worry about storage. I have to find a safe, legal, and secure storage place to hold that oil for 3 months, and that's going to add to my cost. Also, while I'm guaranteed that $5,000 profit, what do I have to do first? I have to buy 1,000 barrels of oil at $80, so I have to spend $80,000 up front. Now I know 3 months later I'm getting $85,000, but I still have to borrow that $80,000 today, so I'm going to have to borrow money and pay interest. So I've got storage costs. That storage includes storage facilities as well as security. And I've got interest. Now, you might say, well, I don't have to borrow the money. Maybe I've got $80,000 I can invest. That's true, but there's an opportunity cost. If I invest in that oil, I'm not investing it elsewhere, so I still have the interest cost associated with that. An opportunity cost of interest if I'm not borrowing the money, and a real cost of interest if I do decide to borrow the money. So the storage and interest are going to take away from my profit. If the storage and interest are less than $5 a barrel, I'm still going to be able to conduct my arbitrage and lock in a profit. If the storage and interest are $6 a barrel, now it's no longer worthwhile for me. I can't buy my oil at 80 and lock in the sales price of 85 and make a profit. Now we also might look at a convenience yield. In our oil example, we looked at cost to us of holding the physical asset, but there might be benefits to holding the physical asset. One thing to look at might be in the case of stocks where you get dividend payments. For interest, for example, if you buy index futures, the actual stocks would pay you dividends, but your index futures contract doesn't. So if you're holding the futures contract instead of the actual physical property, you're giving up the dividends. If you're holding the actual stocks, you're receiving dividends. That's going to lower your cost of holding the actual stocks because you're getting the dividend payments. Maybe it's currencies. Pretend that you're looking at buying currency futures. Maybe you want to look at buying euro futures. Pretend that in the US, interest rates are 2% and in Europe they're 5%. Well, if I actually held the physical currency, I could be collecting that 5% interest on my euros. Because I'm holding a futures contract, I don't get to do that, so I'm giving up that interest differential. So currencies sometimes have a convenience yield. We might look at commodities. Could just be a preference for the actual physical asset. For example, gold. There are some people that think the advantage of gold is in case of some type of Armageddon situation where the global markets collapse. And if the global markets collapse, while the value of a futures contract may go up, what if there's no markets to trade in? Wouldn't you rather have actual physical gold that you can get your hands on? So a lot of people investing in gold would actually prefer to own gold bars or gold coins, something physical that they can possess. That way, if there is some type of market collapse, they don't have to worry about trying to sell their futures contracts. So these convenience yields, instead of a cost of holding the physical asset like our storage and interest from the previous example, may lower the cost of holding the physical asset. When we combine those all together, what we have from the arbitrage pricing approach is that the futures price should be equal to the current spot price times 1 plus the annual interest rate, the annual storage cost, and here we're talking about the storage cost as a percentage, not as a dollar value, minus the convenience yield, and again as a percentage raised to the time. So let's say that our interest was 2%, storage costs were 1%, and convenience 5%. And we had a 3-month position. Now remember, when we're raising to time, we always want to think of that in years, so that would be 0.25. So now let's say our futures price is what we're trying to solve for. Our spot price in this example, let's just say, is 80. So our futures be equal to 80 times 1 plus 0.02 interest costs, storage costs, and then subtract off the convenience yield raised to the 0.25 power. Now let's do the calculations on that real quick. And that would give us futures price of $80.50. So we can use the arbitrage pricing approach to figure out what the value of a futures contract is by figuring in interest costs, storage costs, convenience yield, and how long that futures contract has until expiration. The last thing we're going to talk about in this video is some terminology that you might hear in discussing futures. Contango. Contango is just a situation where the futures price is higher than the current spot price. In our example here, our market was in contango. The futures price was $80.50. Spot price was 80, so the futures was higher than the current spot price. Oftentimes we'll see markets in contango when there are storage costs, and in many cases, especially with physical assets, that's going to be the case. Now, you might also hear the term normal contango, and unfortunately some people use these two terms interchangeably, which leads to a big confusion. Normal contango ties back into our expectations theory a little bit and says that the futures price is higher than the expected spot price. So a little bit different here. Contango, the futures price is higher than the current spot price. Normal contango, futures price is higher than the expected spot price. You also might hear that the futures market is in backwardization. Backwardization is just the opposite of contango. Futures price is less than the current spot price. In this case, the convenience yield is higher than the storage and interest costs, so that futures prices are lower than the current spot price. Normal backwardization, again like normal contango, deals with not the current spot price but the expected spot price. So normal backwardization, the futures price is less than the expected spot price. Let's go through a real quick example. Let's say we have a situation whose price is 100. Expected spot is 101. And the current spot price is $99. Now what would we have there? Well, if we look, we have a situation where the futures price is higher than the current spot price. Futures price is 100. It's higher than the current spot. So futures is greater than spot. So our markets are in contango. On the other hand, right now, the futures are less than the expected spot, which that is our definition for normal backwardization. So here we have a market that's in contango and normal backwardization. These terms can get a little bit confusing, but that gives you a basic idea of futures pricing and some of the terminology you might hear with respect to futures pricing.
Okay, students. This is a summary of what I have discussed in class. Just play this video to ensure that I did not miss any key points. So interesting, right? So he discusses terms. So I didn't discuss this normal backwardization and normal contango just because it can get a bit confusing, but that is based on the expected spot price. So contango and backwardation, he called it backwardization, but usually it is backwardation. So contango and backwardation are based on the actual spot price, right? So the expected spot price I didn't bring into picture. And there's something called the convenience yield. When you do currency futures, when due to interest rate differentials, because interest rates are more in some countries and less in other, there is something called a convenience yield. But that also is usually factored in the price of the futures contract. Any questions, students, on this video or any concept we discussed? I will just show you the Nifty futures and you guys can tell me. Let's look at the NSE website here. So this is, let's see, I would say stock options, Nifty futures. Okay, students. So Nifty right now closed, right, at 15,699. You can see at the left rightmost corner of your screen. So what do you think is the Nifty futures right now suggesting? Futures that expire next week, are they contango or backwardation? Yes, students? Are you there? Are you hearing me?
Yes, sir. Yeah.
Yeah. What do you think? Look at your screen there and tell me, what do you think about the Nifty June contract? It is in contango or backwardation?
Backwardation.
Yeah, it is backwardation. Futures price is below the spot price of 16.9. But July and August seem to be in contango, right?
Yes.
Yeah. So it means that in the short run, so usually in a bull market, when it is going up, futures market is usually in contango. This is another sign that people are not very sure about how the market is going to go. So if one thing to note is the July contract is only in mild contango, right? If that goes into backwardation, I think if the market falls, it will starts falling again. You will see it very quickly go into backwardation. Yes. So the backwardation is a sign that the trend is not very bullish or it's even bearish. So typically in a bullish market, there will be a contango of at least 50 points for the 1 month out futures contract, which is the July contract. But you can see it is only up about 7 points, right? Yeah. You're seeing that, right, students?
Yes, sir. Yeah.
Okay, students. Any other questions you have? Anything worth noting?
No,
Yes.
sir, nothing on mind at the moment.
Okay. So then I'll give you a chance to do your presentation, students. Who can present today? Who's come ready with your presentations? Just on the trades you've done?
Sir, I can do
Okay,
it
Nitin,
today.
you can do it. Mahesh, you can?
Yes, sir.
And Shavi, you can? Can you or yes? Yes or no?
No, sir.
Okay, so next week you can do.
Yes, sure, 100%.
Okay, so Nidhi, I will. Okay, Nidhi, I have made you as the co-host. You can share your screen
Yes, sir. Just a second. Just give me a minute.
and tell me what you see.
Yeah, just a minute, sir.
Yeah.
Sir, can I mean, I'm clicking the option for sharing screen. It's asking the other person who's sharing the screen, can they, I mean, can they stop that?
Okay, I will. Sorry, I have to stop sharing my screen first. 1 minute. Hold on. Okay, now you can.
Yeah. Is this visible, sir?
Yeah, very visible. Go ahead.
Okay. Right. So basically, I did 2 trades. So I'll go ahead one by one. Those. The first trade, yeah, the first trade which I did is for USD and INR. That is forex currency trading. So basically, the reasoning behind this trade was, so since a couple of weeks, we've been seeing that the US consumer inflation, it reached its highest peak in May, right? And it has been surging, and it is going up. I mean, it is predicted that it will go higher in the near future, right? And this will actually lead to increase in the you can say food prices or other commodities, right? So taking into consideration that increase in the consumer price index to about 8.6% in May, it was seen that I'll show you the analysis through the graph, which 1-month graph, right? So this is a 1-month graph, which actually shows a bullish trend. That is, since the currency is depreciating, since Indian currency is depreciating, more number of Indian rupees would be required for each dollar. So it is showing basically a rise in the price of INR, a rise in the price of USD. Right. So taking that into consideration, I did a trade for I invested $100 and I exited, or I exited the trade by making a profit of around
Yeah.
89.25. It's visible, right, sir?
Yeah. Very good. Excellent. Yeah.
Right.
But this
So
must be short term, right? Very short term.
yeah, this was very short actually. So currency for me, for most of the currencies, I think the time duration is very short. I guess most of the people, they go ahead with intraday trading mostly with this,
Yeah, but
this kind of.
you can actually go and open a position on the futures contract assets. If you click the plus button, you
Yeah,
can,
yeah, yeah. I have the second one actually. Just
go ahead.
yeah. So this was the first trade which gave me a profit close to 89.25, right? So the second trade is still in execution. That is, I've placed the trade. It has not yet been executed. So since it's related to the asset, right? So the second trade is basically on a crude oil WTI, which we discussed it today morning itself. So mainly what my analysis was that since the inflation or the consumer price index, if that was increasing, it would lead to the increase of cost of goods or fuel and those kind of commodities as well. So that would affect the prices. So in the coming 1 or 2 weeks, what I expect is that the price might rise a little bit, and from in that duration we can maybe expect a little bit of profit if we buy, or if we invest at the moment. So and then but then the in the future what I would expect is that it would go down, but for this short duration maybe we can take a profit, or we can take a position and we can gain some profit on that. So what my position is at the moment, I have logged in a trade, a buy order at 106.171. And as soon as it reaches around 107.514, I've introduced a sell order, because I don't expect it to go very high because of the impending recession, right? So that's the reason. So this is the trade order which I've put in, and I also have the graph for the analysis of 1 month analysis which was done. So yeah, this is the crude oil future commodity and its graph. So showing a little bit of a bullish position at the moment. But yes, this might decline later on. So for the time duration, we can gain from this. Yeah.
Okay, fantastic. So you can make a document of this, and at the end of the in a month's time, you can share the thing as a report once you complete all your training.
Sure, sir. Yeah.
There you go. So that's well presented. So students, all of you must come up with trades like this. Yeah. This is a continuous process. I'm just trying to make you understand markets. So you should actually do these trades to understand how they work. Otherwise, it's, I mean, I can show you how it's done, but unless you do it, you will not learn. And this is a continuous assessment. So presentations will have a certain weightage of marks in this assessment. So if I'm giving you 25 marks or 30 marks, around 10 for the presentations and 20 for your assignment. So want to make sure you guys have a good feel for markets. But what do you think about the platform, Nidhi? Is it fine? Is it easy?
It is, yeah. So it's okay. I mean, I guess it would be good. It would have been good if we had some Indian, companies as well. But other than that, this is pretty comprehensive platform, I would say, because it gives details on market analysis as well, side by side.
Yeah.
News, right? So that's a very good advantage.
And in fact, that's the only reason I chose this platform over all the others. There are many others too. So but the analysis component you can do right here itself. And you can do more advanced analysis on investing.com, etc.
Yeah, that's right. Yeah.
Okay, who wants to go next? Mahesh, do you want to share? Let me first make you co-host.
Sir, I think we don't need how to be co-host.
Okay, go ahead, Mahesh.
Bitcoin, sir, I traded in Bitcoin last week. Whenever the price came down below the red line and MACD crossed negative, at that time I taken trade at around $27,000.
Okay,
With a target of $20,000, I entered.
sure. I mean, sometimes your trades will lose money. That's okay.
Yeah, around $20,000. It was moving sideways for 3-4 days. So I exited the trade at that position.
Okay. So this is an example. So in the Bollinger Bands, when it first hits either the upper or lower, first time, lower Bollinger Band, you'll get a quick move in that same direction. So you look at that small red candle when it first hit the Bollinger Band, that was a sign for you to go short. If you went short, you would have captured a big move. Similarly, when it first hits the upper Bollinger Band, sometimes you wait, and particularly when it's widening like this, wherever it goes, if it goes up, it will go up a lot. If it goes down, it goes down a lot. Okay, go ahead.
And another trade I taken in ETF related to Dow Jones.
Okay.
Actually, it was a late trade. This candle was after this MACD crossover. I entered around 307 with a stop loss of before candle high. Now it was in open position.
Okay. So make sure you put in the reasoning also when you send your final report.
Yeah,
So this is good. Yeah, go ahead.
that's it.
Okay. So you are still long this position, I presume, right?
Yes, sir.
Yeah. So yesterday was a good up move, right?
Actually, it's short position, sir. I got it.
Oh, it's a short position.
Yeah.
So where you went short again?
This red candles.
Yeah. So in this case, since it is broken Bollinger Band support, you probably where you can expect when it touches the Bollinger Band, it will touch one more time or two more times. After that, it will start going up. So that is something you want to go. So you might have booked profits around about 300 and re-entered now, I think, short potential. So again, I think, see, now it has put green candles. It may come all the way to the red line. That is the risk. But anyway, the trend is down only, I think. If you stay for a few days, you probably make good bit of money, I think. Only thing is down, the MACD is going to cross, but I think small bounce may happen Monday. But after that, I think the red line resistance will take over, I think. I don't think it may cross that convincingly enough. It is near the last time the low is going to act as resistance. I think the last convincing low was round about this area, right?
Yeah, yes.
Yeah. So that may act as resistance in the short term. Okay, then. Thank you so much. Make sure you guys are trading and you share your analysis insights. Okay,
Sure,
so
sir, yeah.
any other things you want from me? I will okay. One more video is there, which I want to do, which is also in touch with okay, so this is Rachana Ranade's video on what derivative trading is. So let's watch it. It's interesting, just a basic video, nothing more, nothing less.
So here's a question for you all. What is the main difference between traditional education
comes after the stock market suffered its worst losses since the financial crisis of 2000. Yes.
Hi guys, CA Rachana Ranade here, and I welcome you all to my new lecture on futures and options. If you remember in my previous video, I had asked you whether you want a separate series on futures and options, and I received so many requests that I thought that it's high time that I should at least give an introductory lecture on futures and options. If you feel more and more interested in that, just let me know again so that I will be motivated to make another separate lecture and a series of F&O lecture series, right? As of now, many people might be just knowing what is F&O. It's futures and options. But exactly what is F&O? Simple. It's a type of derivative, right? Now you might be wondering, earlier we didn't know what is F&O. Now we don't know one more term. And what is that? Derivative. So if you want to know derivatives, check out it in the next section. Now let's understand exactly what do we mean by a derivative. If you want to go by theory first, theoretically or by definition, derivative is a financial instrument which derives its value from an underlying asset. And I'm sure you have understood nothing, correct? So let me explain it properly, one by one. What is it? It's a financial instrument. Shares, financial instrument. Bonds, it's a financial instrument. Similarly, derivatives is what? It's a financial instrument, okay? So like you can invest in shares, you can invest in bonds, you can invest in debentures. Similarly, you can invest in derivatives. Fair enough. So it's a financial instrument which derives its value. It derives its value means it gets its value from what? From an underlying asset. I'll give you a very simple example to start off with. Okay, visualize that you are having something like a payback card. If you have heard about it, then you will understand this in 1 second. Payback card is not a debit card, it's not a credit card. It's a card in which you just gain points. Okay, now how do you gain the points? You gain points only when you swipe your debit card or swipe your credit card. Okay, now this payback, the value of this payback or the points increase only if your debit card spends increase or your credit card spends increase. Okay, so the value of the points increases when the underlying is your debit card or credit card, the spends increase. So the payback derives its value from the underlying asset, which is a debit card or a credit card. This is a very crude way, but it's a very simple way of explaining what is a derivative. I'll give you practical examples now. For example, there is a derivative of, let's say, a stock derivative like Reliance Industries derivative. Okay, if I'm saying that it's a future of Reliance Industry, okay, the future of Reliance Industry value will increase only when the underlying, which is the stock of Reliance Industries, increases. So one more time, if the value of stock of Reliance Industries increases, automatically the derivative of Reliance Industries value will also increase. Number one. Number two example, let me give you an example of a commodity derivative. What could be a commodity? Simple example can be wheat. I have bought a wheat derivative. When will the value of wheat derivative increase? It will increase only when the value of the underlying asset increases. What is the underlying asset? It's wheat. If wheat value increases, the derivative increases. If wheat value decreases, the derivative value will decrease. Right? One more example. I'm talking about currency derivatives, let us say, and I'm talking about US dollar derivative. When will US dollar derivative value increase? Only when the US currency becomes stronger. If US dollar increases, then automatically the US derivative will increase. Okay, so what is a derivative? One last time, it is a financial instrument which derives its value from the underlying asset. Okay, I don't think there can be any more examples. Okay, one last example actually. One last example, what could be a derivative? It could be an index derivative also, okay, like a Nifty derivative. Nifty derivative, the value will increase only when the underlying asset, what is the underlying asset? Nifty. If Nifty increases, Nifty derivative will increase. If Nifty goes down, Nifty derivative will also go down. Okay, and on a lighter note, I can say that you all are a derivative, okay, and I am the underlying asset. Why? Because you are deriving knowledge from my knowledge. Okay, if I have a stronger knowledge, if I increase my knowledge, automatically your knowledge is going to increase, right? So always remember me as the derivative and the underlying concept. Now let's come to what are the types of derivatives, because I'm sure you might have heard a lot of people talking about stock market wherein they say that we have taken a position of futures or options, but you might not have heard people saying that I bought a derivative. Okay, but now I'm sure everyone knows what's a derivative. So now it's time to understand what are the different types of derivatives. So here are the different 4 types of derivatives wherein we say forwards, futures, options and swaps. These are primarily 4 types of derivatives. Okay, but as far as the stock market is concerned, forwards and swaps, they don't form a part of trading. Okay, so can you trade in futures? Yes. Can you trade in options? Yes. Exactly what is the difference between futures, options, that itself is a different content of a lecture. So again, if you want to know more about exactly what's a future, what is an option, what is a call, what is a put, that itself makes a separate lecture. Let me know and I'll definitely make a separate lecture on these content as well. Now that you have understood what is a derivative, what are the different types of derivatives, only futures and options can be traded on the stock market. The whole question is that why derivatives even exist? Okay, there's an amazing thing which is there about derivatives, and for that you need to understand that derivatives are primarily used for 2 major things. Which are the 2 major things? One is for hedging and one is for speculation. Okay, if I'm talking about the simple one, first is speculation. Speculation comes from the normal English word to speculate. To speculate means I'm just trying to bet on something. Okay, don't look at it from a negative sense that finally stock market is betting and satta and all that. Betting means what? I'm trying to trying to gauge as to what will be the direction of the market. So for example, if I feel that market will go up, okay, then what am I doing? I'm speculating that market will go up. I'm thinking, I'm feeling that market will go up. Okay, am I taking this position to earn profit? Yes. Okay, if I feel that markets are going down or markets might go down, what I will do? I will do a short sale. Okay, what do we mean by short sale? In simple words, you sell first and you buy later. Okay, I'll give you a simple example on this. If you remember, just at the beginning of the video, when markets were going down, I was very happy. Why was I happy? Let us understand. When market was around 9,500, I thought that there is a great chance that market will fall down. Okay, so what did I do? I sold Nifty, and now you know Nifty derivatives can be sold because underlying asset is Nifty. Okay, and what is a derivative? Nifty future or Nifty option will be the derivative. So what did I do? I sold Nifty at 9,500 level. If the market goes down and down and down, what will I do? Let's say the market goes down from 9,500 to 8,000 level. Okay, will I be happy? Yes. Why? Because I've sold at 9,500, and if the market really goes down to 8,000 level, this 1,500 gap is my profit. Because what I will do is when market goes down to 8,000 level, that is when I will buy. Check this out. Will it be one and the same? Buying at 8,000 first and selling at 9,500, case 1, versus case 2, selling at 9,500 first and then buying at 8,000. Finally, it's bottom to top, top to bottom. But then where's the difference? The difference is that if market is at 9,500 right now, and if I feel it will go down, that is where derivatives come into play. I can sell my position first, I can wait back, I can relax. So right now, even if market is going a little bit up and down, I have not still closed the position. What do you mean by I have still not closed the position? I have sold at 9,500 and that position still exists. So I'm just praying every day. So whenever I read the newspaper and I see that market is going down, whenever news channels say market is going down, I'm like very happy, because the target is that it should go down to a good level. If it goes down, that's when I'm going to make profit. Okay, so why did I take this position? I took a position to speculate. My speculation, my thought process was that market will go down, and that is why I had entered into this position. Fair enough? Yes. This is part 1, speculate. Part 2, why do I take a derivative position? Is because I want to hedge my position. What do we mean by hedge? Hedge means I enter into the position to reduce my losses. Okay. So please understand again, what is the basic difference between hedging and speculation? My primary intention of speculation is to earn profit, but my primary intention of hedging is to reduce my losses. Okay. So why Or how can I do that? Simple. Assume that I had bought many shares in my portfolio when market was at 11,500, was at 12,000, was at 12,400 also. So you can imagine I have bought stocks worth rupees 10 lakhs. बोलने में क्या आता है? Okay, or 10 crores, whatever, I can say any amount, right? So I have bought stocks worth rupees 10 crores, let us say. What can happen? Because the market is going down, there's a great possibility that the value of stocks which was 10 crores is now maybe 5 crores. Okay, so I know that my value of my portfolio is going to go down. Now to reduce this losses, I want to enter into a profit position. I want to compensate for that losses. And if I want to take a position to compensate for the losses, that is where I say I enter into a derivative contract with an intention to hedge my position. Okay, so that is hedging. See, finally, how do you trade, whether you buy or whether you sell? It is going to be the same. How do you differentiate hedging and speculation? It is the intention. Okay, if your intention is to only earn profits, it's pure speculation. If your intention is to minimize your risks, minimize your losses, that's where we call it as a hedging. Okay, I have not talked about any strategy as of now. I just wanted to clarify the difference between hedging and speculation, and very important, why derivatives exist. Well, that was my attempt on how futures and options can be taught in the most simplified format. Because when I remember when I was in CA final and when this topic was introduced to us, our teacher had taught this for 3 hours continuously. When we all came outside the classroom, no one was talking to each other. Everyone had gone in a trance. And it was like we could actually feel our head going very hot. So I don't want you all to go through this. We will cover these topics part by part at our own pace. So do let me know if you would want me to talk more and more about features and options. I hope you're enjoying my content. Do consider subscribing to my channel and hitting.
Okay, students. So she has explained it in a very basic manner. Now, the reason I did not start a new topic is only 3 of you are left on the Zoom. So the new topic is options. It's a very interesting topic. In fact, your second assignment is going to be based on option trading strategies. So yeah, so I'll start it next week. So I will leave you with any questions, clarifications, anything else you want to ask. Now is your time. Yeah, students, anything?
No, sir, nothing.
Sir, like she mentioned the difference between speculation and hedging.
Yeah.
So similarly, if you can throw some light on the differences between arbitrage and hedging, like with the objectives of both.
Okay, so in arbitrage, basically you are making riskless profit. Okay, right? You are buying the spot and selling the futures. Okay, why do you do that? Because there is a difference in spot and futures. Okay, so the spot is the price today, futures is the price somewhere down the line, which is a derivative. Remember, they both go hand in hand. When spot rises, futures rises. So, but if you are next week and futures are expiring on Thursday, and there are about 5 or 6 points worth of arbitrage you can have, then it may be, if there is a particularly sometimes what you will have, Thursday, right, futures expire. So both futures and spot should be the same. But Monday of that week, you will find that futures is ahead by 50 points. So what can you do? Sell the futures, buy the spot and make free 50 points. That is arbitrage. Okay. Hedging is when you have something with you, when you have a portfolio and you feel in the short run it may go down, then you sell nifty futures and hedge. So you are protecting your portfolio against downside by hedging. Yes, in arbitrage, you're just buying in one market and selling in another. Same asset. Okay. So basically you are trying to make riskless profit. But in hedging, you are trying to protect your portfolio from going down by selling futures against it or by buying put options. Is that clear?
Yes, sir.
Yeah. So that's the main primary difference. In fact, I will play a video on hedging in the next class. before, since that's a very good question you asked, and that's a question that crosses the mind often. So since only 3 of you are there, I don't want to play the video now. I'll play it at the beginning of next class, but do remind me. Any other questions, students?
No, sir.
Yeah, do send me feedback on the WhatsApp if you have anything, particularly if you want anything, if something is not explained properly. I don't take anything personally, guys. At the end of the day, you guys are all students with work experience. So anything I do, I would like to improve. Yeah. So please do send, even if it's negative feedback, don't keep it with you. Send a WhatsApp message or two saying that you didn't understand this or you didn't understand that. And I can come back and explain to you, either through a video or through my own analysis or whatever.
Sure, sir. Yeah.
Okay, students, thank you then. See you all next Saturday.
Okay, sir. Yeah. Bye. Have
Thank
a
you,
good
sir.
weekend, everyone. Yeah.
Yeah,
Thank you.
yeah, Chavi, make sure you and the others please send. You guys have a WhatsApp group of some sort, right?
Yes, sir. Yeah.
Where you communicate with each other. Please do remind the students that the simulation assignment is broken up as 20% of the actual report and 10%, sorry, 20 marks for the actual report, 2/3 for the actual report and 1/3 for presentations. So students have to present in class, so they can't take that for granted. Please do put a reminder in your group. Yes.
Sure, sir. Yeah.
So I see my regular MBA students have this bad habit of doing everything together in the end, and it doesn't work out. So this is a learning experience, right, for you guys. So this program is being taught a little differently. So I want to make sure the learning and the practical side of things comes out more. So hence spending more time on the markets, analysis, and all those things. Okay. All right, students. Thank you so much. See you next week. Bye. Have a good week.
Bye, sir. Bye, everyone.